Good morning. Happy Monday. Um, Big week coming up in terms of earnings. 33% of the S&P reports this week. Late today is a slow start. Tomorrow, um, SK Hynix, Visa, Coca-Cola, UPS, Boeing, and then Wednesday, Microsoft, Meta, Qualcomm, ARM, Starbucks, Robinhood, Procter and Gamble. Thursday, Apple, Amazon, Shell, Mastercard, Anheuser Busch, and then Friday is Exxon and Chevron. We also have the Fed meeting and the press conference that's on Wednesday. So we've got a lot. After this, after earnings ends, August will be a slower period of time for the markets generally, news cycle wise, and then also in terms of trading. Friday was a messy day in the market. Didn't the Nasdaq got hit the hardest, down a percentage point. The Dow was down about 0.4%. S&P was about flat. Today, the market in pre-market action is very strong. The Nasdaq is up a point and a third pre-market. Dow up over a percentage point, and S&P getting closer to a percentage point. That on the general hopes that retaliation or strikes by the United States on Iran are paused, um, and maybe then not an escalation further of the conflict. Oil is down a lot this morning, about 7 or 8%, depending on WTI or Brent. And so things are, at least at this moment, decent in the world. There's a bunch of news to get to in the tech, chip, AI, compute space to talk about, inclusive of Samsung and Broadcom, inclusive of NVIDIA and OpenAI, inclusive of China's largest chip maker going public, CXMT. Um, so we will get to all of that in due course this morning. And LeBron James is going to the Philadelphia 76ers, announced late on Friday. Um, to start with a story that we've covered a lot here, Paramount, Skydance, Warner Brothers, due to the lawsuit um, that has been initiated by the state's attorney general, as Eladio properly highlighted, all blue states with all blue states attorneys general, attacking the merger. And even though the merger did get EU permission, um, the companies have now decided to delay the acquisition to as late as June 2027. They're going to go to court and they're going to fight. And the litigation is going to be costly for the company, for Paramount, and it's also going to be costly vis-a-vis the merger. Employees are incredibly on edge. There's been a fair amount of reporting about that. And so this limbo is going to continue for quite some time as they decide to go to the mat on this. And I think, I think Joe Carlasari detailed, I think it was last week, the various arguments that are being made by the state's attorneys general and what the defenses are by the companies, largely around what the quote unquote market is. In other words, is it just major movie production companies, or are they competing against every, you know, tech slash media company as well? Is that considered the market? So we will watch and wait as this twists and turns, but for now, the whole thing's on ice. Um, so let me go back to CXMT because some people in the chip space and some people who are advocates for the Chinese stock market, China generally in the AI race, are pointing to this as a huge success. So CXMT went public in Shanghai earlier today. The stock was up on the first day of trading 466%. Even with that bump, the company comes in substantially short of the value of either Samsung or Micron or SK Hynix. But nevertheless, I guess for those folks that want to see some promise vis-a-vis China, they will point to this. You know as well as I do that China's stock market is not as free and fair as U.S. markets are. Not to say that there was government involvement, manipulation, what have you, in this, but there are certain issues around China shorting is not generally allowed. And maybe there were big buyers connected to the government. Dave Nikoski, you have a point on that?
Yeah, my belief is it's literally just money flow. I called the bottom in China July 1st. China, the FXI is up 12% over the S&P 500 since that time. It wasn't a great looking chart, but you got about 10% of the names above the 200-day moving average. Usually that's a good buy signal, not to the day, but usually looking out, a month to 6 months out. You get a great rebound out of it. It's the same call I did, with Korea back in December, beginning of January of 25. You saw it in most emerging markets. Most emerging markets across the board way outperformed the U.S. market last year. So I look at that as just a parameter of just how much apathy is in a market, because you tend to make major bottoms on an apathy, and whether it's a major bottom or a cyclical bottom, it's certainly that it hit every parameter that I needed to make a call. I don't make the markets go up. I'm just a reporter, right? I don't make the data. I just look at the data. So on the CXMT, by the way, they are getting more per unit in terms of what they're selling DRAM at than Samsung or SK Hynix, by the way. So they're actually selling memory higher than the two, participants in that area that have been doing it a long time. So I just looked that up. So just to get a clue as to why CXMT is rallying as much as it is.
I trust that
Actually,
their overall market, by definition, is has to be naturally much smaller, right? I don't expect CXMT chips to make their way into a U.S. manufactured device ever.
well, I think Apple approached them to get it. The problem is you can't get it. A lot of companies have just stopped producing DDR RAM because they want to go to the high bandwidth memory for the GPUs, right? Because so I think it's someone that's filling a vacant spot where demand was there, but it doesn't have the premiums that the high bandwidth memory does. So it entered into a spot where Samsung and SK Hynix actually cut back on production. So in terms of DDR RAM, they are getting a premium, and they're getting the premium because there's just a shortage of it. That's the way, at least I am reading it from the data I'm looking at.
Thank you
Thank
for
you.
for the highlight. Um, let's stay for a second on foreign investment. I saw this over the weekend. Quite interesting. Foreign purchases of U.S. equities um, are up to a record high uh, in history over the last 12 months. Over the last 12 months, $850 billion of foreign purchases of U.S. equities. Just to put it into context, that number has quadrupled since the start of 2025, quadrupled, and 450% above the average recorded since 2000 for any 12-month period. As a percentage of total equity market cap, foreign purchases are about 1.3%. It's the highest level since post GFC. The highest we'd seen before this was in 2021 during the meme stock frenzy. Um, Look, it can cut both ways, obviously, in the sense that, sure, at 1.3%, foreign purchasers are not making up a material portion. And so, therefore, there's certainly room to go higher. All that being said, since it's such an inflated number relative to historics, if anything happens on the global front, or if confidence in the United States, wavers a bit, the deflation could happen fairly quickly relative to what the historic average is. Eladio, good morning. Go ahead.
David, I think some of that has to do with the fact that the US dollar is continuing to get stronger and stronger and stronger. A lot of people really aren't talking about that, but that's normally a tailwind not a tailwind, a headwind longer term for the market and for oil, because as you well know, since oil mostly gets sold and bought in dollars, obviously when the dollar gets stronger, it also makes it harder for the companies that are indebted to the United States in dollars to pay their loans and IMF loans. But I think that what are you going to do in really what continues to be a rising interest rate environment, at least for the time being? You're going to buy bonds. I mean, the fact is the U.S. stock market basically has offered the biggest offset off the theoretical debasement of the U.S. dollar, and it's been more effective than certainly crypto in the last 2 years. So I think that the U.S. dollar is at some point going to become a problem. I've made several references about the 1987 Plaza Accords, where they had to step in. The yen continues to weaken against the U.S. dollar. The rupee. I mean, and I put a chart up last week, I think, about GDP in terms of per capita, and the per capita GDP of these countries is getting absolutely decimated, and that's their standard of living. Because in the end, what vehicle do you use the most when you're buying anything? Currency. So if your currency depreciates at such a level against the dollar, that may be good for exports in the longer term, but in the short term, again, it's an erosion of purchasing power. And the U.S. stock market has shown the rest of the world since COVID that it's probably the best place to offset any decline in currencies.
Thank you for that point. Um, Mike Cantro, I see you're in the audience. If you want to go ahead and jump up on stage, you're more than welcome to, although I think we might have lost him just now. Maybe X is glitching today. I'm not sure because Dave Nikoski just dropped down as well. Um, I'm sorry for the technical difficulties, folks. Oh, here's Mike Cantro. I see him. Mike, if you want to come up on stage, you're more than welcome to. Brandon, good morning. Hope you had a good weekend. All right, let's get into Samsung, Broadcom, OpenAI, Nvidia. So Nvidia is in talks with OpenAI to guarantee 250 billion in financing for a data center in Ohio. The guarantees will help OpenAI lease a 10 gigawatt project that SoftBank is developing. The project entirely could cost more than a half a trillion dollars. That would be the largest data project ever announced. The power for the project is controlled by the U.S. and funded separately by Japan under a trade deal. And Howard Lutnick is reportedly involved in deciding who will get the power. This single data center, is going to be a massive story. On the Samsung and Broadcom side, we had heard rumors that Samsung and SK Hynix are going to make very large announcements relating to U.S. companies in upcoming days. It seems that this is the Samsung announcement, which is Samsung and Broadcom signing a $200 billion deal, where Samsung will build Broadcom's next gen AI chip, and they're teaming up on next gen HBM memory, and that deal runs through 2030. Oh man, I lost Brandon in that entire monologue. I apologize. Is does anyone? Oh man, sorry for the technical difficulties this morning, folks. We'll try to recoup here. As soon as Brandon gets back, hopefully he does. We'll explore these two stories. They are important because, yes, we continue to chronicle numbers that are in the hundreds of billions of dollars, and with that comes, on the one hand, incredible opportunity to the upside. To the
He's
Yeah, I see
back.
him.
He's back, David. If you add me as co-host, I can
Oh,
start adding
excellent.
speakers so you can
We'll do
focus.
that. You got it. All right, Brendan. Good morning. I'm handing it over to you.
Good morning. I missed a good portion of that. I'm not sure what was said. X is glitching pretty heavy today for me, at least. Um, yeah. So if we were talking with OpenAI, I think it's a major. It's a. Can you hear me well, or am I just
You
glitching the
you
fuck
mute
here?
you muted for a second, but right now you're pretty good. So keep going.
Okay. Okay. Yeah. So the NVIDIA OpenAI deal. It's not direct financing. I think if guaranteed and or to potentially guarantee, and I think it's just a tremendous deal. I mean, when we look at these states that are saying we're going to accept data centers, we're going to embrace them, like Ohio is, versus states like New York City, which are putting a moratorium on them. I think that we're just going to see a tremendous bifurcation in um, and just local economies. And this is going to be a huge deal for Ohio, the biggest ever. Um, I think that it's huge. I mean, what is it? 800 megawatts of capacity that this is going to add in. I mean, just imagine the jobs this is going to create for Ohio. Imagine just the economic benefits this is going to create. We've talked about states like New York and others that are out here trying to fight against them and ban them. It's not. It's just. It's a foolish endeavor. I think. But well, that's my personal opinion. But history will tell
By the
it.
way, just
Um,
for detail, the first phase is 800 megawatts. The full build out is 10 gigawatts. Okay,
yeah.
go ahead.
I hate this. I swear to God, I'll punch Elon in the face if I see him. This is ridiculous. Can anybody hear me?
Yeah,
We
a
can
lot of
hear
different
you.
accounts are glitching out this morning.
Okay.
A lot of accounts are. It's like I've heard David glitch out. I've heard Brandon glitch out. No idea what's going on.
Yeah, this is pretty crazy. They don't support spaces at all. I'll go on a little rant about that. I think X is obviously it's a tremendous platform. I think I just got an invite from Justin Brady to speak. I'm up here talking like that's crazy. But anyways, so I think X is such a tremendous platform. But what it has not supported spaces at all. Nikita is obviously a tremendous product manager. The stuff that he's done has been phenomenal. They've done great things with the algorithm, but they have not supported spaces at all. Actually, previously, and when it was Twitter, before this new administration came in, uh, and when I say administration, I mean X, Twitter versus X. They had a thing called the Spaces Sparks program, and I was a part of it. And really supported the Spaces program. They paid actually to host their spaces. I was part of it, and it was awesome. They would take feedback and implement stuff within a day, and now it seems like they don't care about spaces. Anyways, back to what I was saying about AI. The other great story, I mean, big one. I don't know if people saw. On Friday, I believe we talked about everybody that was signing this. We support open source stuff from NVIDIA and Jensen. um, Almost everybody in tech, every major corporation from Meta to Google to SpaceX AI to even OpenAI has signed that they support open source models. The only outlier, guess who, is Anthropic. You guessed it. And I get a lot of flack in the comments sometimes or on the show. It's like, why do you keep mentioning Anthropic? Why do you keep mentioning on? They're an ideological company. They're not an AI company. They're not a whatever. They're leading the way in AI, but they're an ideological company who is completely against actually giving intelligence to the vast majority of people. I think they are far on the wrong side of history. And I think this is, why are we talking about AI and whatever in a finance show? Well, it impacts finance. Like they're planning on IPOing soon. And it's my belief, it's my thought, even with their tremendous growth and their revenue, they're not going to be able to IPO at $1 trillion valuation. There's just no way possible. And I don't even think they want to. I mean, I just really think they want to be an ideological company. They want to take your money and they want to control all intelligence. And so is what it is with them. I'm not going to get too far into that because I could go on for days because I think that they're just a terrible company. But if I'm going to, the other thing that came out this morning alongside that letter, and Jensen announced it, is this new thing where it's an open source security alliance essentially, and that was put out by NVIDIA. A lot of other people have signed on to this as well. And if you don't know what it is, I mean, the best way I could put it is it's an SRO. It's a self-regulating organization. It is the complete opposite of what Anthropic has been pushing for. And what does an SRO do? They regulate themselves. They say, hey, we're going to all look at this stuff together. We're going to see, does this need held back a little bit? Does this need pushed forward a little bit? Like they regulate each other. And this is it is the absolute best path forward versus relying on government regulations. And Anthropic wants people to rely on government regulations because they want regulatory capture. Everybody else, I mean, there's not literally everybody else in the industry would rather say, let's regulate ourselves, let's regulate each other. And to be honest, that ends up working out better in the end game. And like I guarantee I'm going to open up comments and there's going to be somebody in here defending Anthropic and you just don't know what you're talking about because they're actually trying to withhold stuff from you. I mean, I'm going to be as blunt as possible about this from you. They're trying to withhold intelligence from you because they don't believe you can handle it. And it's the silliest thing because again, and Jensen has mentioned this, like if you guys heard me talk on Wednesday, Thursday, Friday of last week, you would have got all the talking points for the rest of the week and the weekend that you saw on Twitter and every major news organization and podcasts and everything. The open source models are the ones that solved the hacking issues that happened with Hugging Face. The closed source models couldn't do it, wouldn't do it, just flat out ignored it because of regulations, because of these guardrails we put up. The open source models are the one who did it. So who are we going to want to, why would we continue to kneecap ourselves here and play that game? It just doesn't make sense. And why does this matter for finance? Because big IPOs are coming up. If those big IPOs fail, that causes a ripple effect for the rest of the market. Money's going to have to rotate somewhere else eventually because if money's not going into these supposed $1 trillion valuations, then it's not going to make sense for them. I mean, we're an Anthropic, like financially, is supposedly or allegedly a great company with rumored over $70 billion in ARR right now. Over 70 billion. They're growing at a tremendous pace. But I can tell you right now, there's people that are churning off. There's enterprises that are turning off, and within I think like 2.5 hours, Hugging Face or not Hugging Face, I apologize. Within 2.5 hours, Kimmy is officially releasing their open weight model for the Kimmy 3, whatever. And so that's going to cause, I personally know enterprises and people within these enterprises that are going to be rotating off of and dropping their cloud spend, or at least decreasing their cloud spend, because A, they don't support the organization, but B, it's going to be far less expensive than for them to operate on it. So that's where the finance comes into all this. I'm not just coming on here to bloviate because I want to hear myself talk. I don't even like hearing myself talk. Please continue.
The best. Brandon on Monday mornings, all charged, my friend. First of all, I have to go back to one of the points you made. Folks, you got to be here every day. We cover stuff. I'm not saying we shatter things and break stuff that nobody ever heard of, but we put things together in a way that I think the rest of the popular press takes a little while to catch up on. I mean, we've been talking about open and closed source models for quite some time here. And a lot of financial popular press this weekend spent a lot of time on it. This all started with Alex Karp, which I guess because of his demeanor was written off as a wacko. But now Satya Nadella has jumped on, Zuckerberg's on, Sundar Pichai is on, CEO of Google, DeepMind is on. I mean, everyone's on board here, and it's important. I don't know how you try to take away your feelings and emotions about this for a little bit, because I think just recognizing where the arguments are, who is going to be the center of power, which way the law and regulations are going to be formed is very important. And not that we have all the definitive answers, but it's definitely important to be here for it. Um, Over the weekend, also, or late Friday, and we could, by the way, we could carry on with the everything relating to NVIDIA, OpenAI, Samsung, um, and Broadcom. But late Friday, the co-CEO of Blackstone's private credit fund resigned. So this is the other co-CEO. So now they are co-CEO lists over at Blackstone's private credit fund. Whether this is about laying blame on somebody or somebody's, or this is about life getting too tough and someone simply saying, show me where the escape hatch is. I gotta go relax for a little while. I can't take the heat has gotten too hot in the kitchen. Begs to be seen. The CEO that has left as of Friday, unlike many other Blackstone executives, is not someone with an incredibly storied, super high class institutional career. It's not like this fellow, Jonathan Bach, came from Goldman, or Citadel, or some other illustrious pedigree. He came from Barings. And not to say anything about Bearings, but I think the best take on this is that this asset class became way too big for a person that had not handled that size or that high profile, in that much of a pressure cooker environment investment. And maybe it just was time to, from both the institution's perspective and from the executive's perspective, to move on. Blackstone's private credit fund is, in the hundreds of billions of dollars. And, Jonathan Bach, this may be his first time in his life managing that kind of capital with this type of scrutiny in the public sphere. And it may not work. All that being said, it's really important to recognize that it is what it is. I mean, the co CEOs have left. They're going to need to find other folks to run this. And it's not as if Blackstone's private credit fund is winding down by any stretch. I think it's an asset class that Blackstone, along with lots of other asset managers, love. It will continue to live on. It may change, it may modify, it may wax and wane in terms of size, but it's here to stay. And I think they'll probably look for somebody who is capable of being the face of a business that is hundreds of billions of dollars in size. Um, I did want to also, I guess, in departure news, Patreon. I don't know how many people here know Patreon. I know it only because I have a relationship to a gaming business. Patreon is generally in the payments space. They laid off 20% of their staff. And quote, "We are not making the above changes because we believe AI replaces humans." I assume that that's what you have to say, regardless of what you really believe, because the humans have, an opportunity to revolt. The bots, not so much. So that was their statement. But 20% of the workforce is pretty serious. The payment space is really challenging, and as Carlo knows, if stablecoins get their way, it will become an even more challenging space. Competition will be even higher than it is now. Carlo, why don't we talk a little bit about stablecoins, clarity, if there was anything notable that happened over the weekend? Also, we have had 3 crypto exchanges shut down in the last month or so. BitMEX, Bitmart, and AscendX have all closed. We had Jack Mallers walking away from his 21 company. And so, lots of folks are saying, well, this is what happens at a bottom. Essentially, the chaff that has been holding on for dear life gets flushed out. And this really identifies a bottom, or at least a development point inside of the crypto sphere. Good morning, Carlo. Over to you.
Good morning, David. Good morning, everyone. So, yeah, I think it is part of the bottom cycle. It is inevitable. And I think another aspect of it is we're seeing major players emerge in the centralized exchange space. Robinhood coming on board very aggressively with its crypto entry. Its stablecoin daily volume, its real world asset volume has just absolutely skyrocketed since they launched their EVM Ethereum based chain. And now we are seeing Coinbase offering more and more diversified asset class products. And I think when it comes to trying to capture consumer attention, companies like Robinhood, off the meme coin trading craze, are already embedded in people's phones. Coinbase, of course, is already embedded, huge volumes on the App Store. So I think it's largely consolidation into the majors, and it is a sign of diversification and obviously a trend line that I think points towards maybe we're nearing the bottom, hopefully. Numbers still continue to remain stable. Bitcoin sitting at around 65,000, 64.5 throughout all of this uncertainty about the Clarity Act. While the Clarity Act doesn't absolutely touch or impact Bitcoin directly, it is the leading indicator in crypto, and the fact that it's remained stable is impressive. Ethereum seems to be looking for a breakout here. I think Ethereum, again, on the heels of all the Robinhood volume and some other interesting things that have happened with respect to NFTs, which are now starting to see a bit of renewed interest. There's a token protocol that launched, FWA, Fake World Assets, that has captured a lot of attention in the timeline and has created a lot of activity on the Ethereum blockchain as well over betting, essentially, on the potential to capture a NFT that is in that protocol in a play to spin sort of an environment, and that's certainly helped to revive activity on Ethereum. And of course, people still remain very bullish on Ethereum as being probably the winner when it comes to smart contract execution, if and when the Clarity Act passes, which gives a nice segue to the Clarity Act. We're hoping that Senator Tillis will get this thing teed up for a floor vote. There's been some uncertainty about that, but he seems to want to put it to the floor. We had Elizabeth Warren's, once again, unhinged, one-sided rant about just how dangerous the Clarity Act would be for consumers. And again, she's ranting about money laundering as being, the drug dealers and the cartels and so forth are going to win if the Clarity Act passes. I had to respond to that and remind people that once again, the banks facilitate, not directly, not actively, but indirectly facilitate far more money laundering than all of crypto combined. It's not even close. And the fines that banks have paid even exceed the sum total of all crypto money laundering. And it's not even close. Not even close. So when people want to fearmonger and they want to stifle this innovation, they do it at a significant cost. And I think this is the thing that really needs to be pushed. And, I'm sorry if I'm ranting on this, but I'll just kind of follow the theme this morning and rant. If we don't get clarity done, then we stand to lose significant leadership in development and innovation of blockchain technology. The rest of the world will push forward. Markets will trade 24/7 over tokenized assets, anything and everything, including we saw last week cattle being tokenized and put on chain by Brazil. We will lose to Asia, the Gulf states, the EU, Russia, China, and even South America when it comes to digital asset innovation if we fail to pass this piece of legislation, because we will drive innovation offshore. And despite Warren's continued pleading that this is bad for consumers, the alternative, which she's proposed none, she just wants to see this bill dead on arrival, but has proposed no meaningful alternatives, would essentially make it more dangerous for consumers. So if you believe in this technology and if you believe that it's the future of finance, which I sincerely do, then this is a good time to probably get vocal with whoever is your sitting senator in your jurisdiction if you're in the US, and let them know that you think the Clarity Act needs to happen, because it is literally the 11th hour for this thing. So hopefully we see it happen, David, and I'll continue to monitor that as well. Back to you.
You got it, man. If the and South America and even South America did not get you, then you're a lost cause at this point. Even South America could lap us on this one. And I do want to go back for a second, folks. I'm so thrilled that the show is a resounding success, and we have lots of people join us every day, and lots of new people come on and questions and back and forth and so on and so forth. But listen, my friends, my family, whatever, up on stage, we wake up every morning just to banter a bit. We definitely don't wake up to put on our thickest of skins this early in the morning. Like, if you have something negative to say, just keep it to yourself. If you don't like somebody's opinion or even the way they express it, please just keep it to yourself. It's really not worth the breath or the keystrokes that you're typing out on here, whether you disagree with me or anybody else. Please, please, we're not here for that. I mean, you could totally take issue with the facts, the underlying facts of an argument, no problem. But, ad hominem attacks are not cool at all. We're way too old for that, all of us, even the youngest of people here. And we wake up too early and get paid nothing to do this. So please keep your comments to yourself. You go ahead and attack me when I'm on TV. That's fine, but not in this space. Leave it here. Anas, good morning. I hope you had a restful
Just
week.
makes
Yeah.
just makes it feel old school, like we're on like that's what I used to get on the old radio days on the text line. People would text the craziest stuff.
Good
Yeah,
morning. Yeah.
it is what it is. Anas, good morning. Please tell us what's going on with the price of oil. Is it going to stay this low, or is this a joke?
Yeah, I will go over this. I just want to mention something about those negative comments because I do get those all the time. And historically, even when I was a chief economist for the premier private equity that's part of the Carlyle Group, basically, I used to get negative comments for the following reason. I'm just going to explain it so people can understand what's going on. When you have an analyst who is telling his company and his boss something, and then my boss talk to his boss and say, well, my chief economist said this and it's the opposite of what that guy says, I am immediately the enemy. So that's number one. Number two, when you have someone who is putting, let's say, $50,000, a retail investor, in something, or bought options that expecting Brent to go 150, and I come on Twitter and I say, well, the bulls have no case. I just destroyed his thesis, destroyed his money. Probably he'll look at it as I'm killing his family. So he's going to be against me. So, in a sense, whatever we say, we are going to find those people who are going to be offended and they think we are after them. They don't have the ability to think that, look, we are volunteering this, we are doing this, this is a civil service we are doing to everyone. They don't think about it this way. And the reason why, the bottom line, the first story is the legitimate story about the analyst who is telling his boss something. But for most of those guys on social media, who they think they are investors, and the fact is they are not investors, they are gamblers. And that is part of the problem. The behavior of the gambler is completely different from the behavior of investors. So you get the backlash on whatever you say, you get the backlash on that. And if they lose money, when gamblers lose money, and look at the stages of gamblers' addiction, look at the stages. And the most important stage, I'm talking about the scientific definition of stage three of gamblers, basically. It's not their fault. They lost money because of you, because you were on the show this morning and you said something and the market crashed and you are responsible. It's not the gambler. And they lash out at everything. So this is part of the problem that we are facing. Oil prices are down today by more than 8%. And here I would like to explain an issue that looking at Bab el Mandeb as separate from Hormuz is a mistake. We have something like the multiplier effect here, because if you have no issues with Iran, no issues with Hormuz, then you have no issues in Bab el Mandeb. And the opposite is true. So, in a sense, we have a multiplier effect. This is different from what's going on in the Black Sea, because that is independent. And here I would like to coin the term the three C's crisis. The three C's crisis basically is the Red Sea, the Gulf, and the Black Sea. That's what we have today because we have problems in all of them. Two of them are related. One of them is independent. Something I've been talking about for a while, and I'm still learning it. I know about it, but I don't know what the extent of it. I always talked about Iran's cronies and other countries, the international arm of Iran. It is those other guys, the third parties, etc. But we are still learning about them. All of a sudden today, we are hearing about this kind of another effort at MOU or some sort of negotiations. And here I would like to point out, since we were talking about those who are lashing out at us or others, is to really pay attention and read between the lines. For example, those who want oil prices to go up, they are saying, look, the Iranians are saying that they are not negotiating with the Trump administration. So this news about negotiations are not correct. And therefore, oil prices should go up. Well, pay attention to the details because the Trump administration, they are saying they are negotiating. The Iranians are saying we are not negotiating, but pay attention to one word that's been missing: directly. So the Iranians are saying we are not negotiating with the Trump administration directly. So do not forget this important word here, because you can build a kind of an investment case on nothing when you miss a word like this. So again, we are still learning about those cronies and third parties because at the time when there are no attacks between Iran, no U.S. attacks on Iran and no Iranian attacks on other countries, all of a sudden we have attacks on oil facilities just like 2 hours ago on Saudi Arabia, on oil facilities in Saudi Arabia. But from where? From Iraq, not Iran. And we have attacks on Jordan, not from Iran, from Iraq. And here is the problem that I don't know why the media is not catching up with this. Those cronies, the Iranian cronies who are well trained and they have all the weapons and all the money in Iraq, guess who created them? Guess who made them? Guess who trained them? Can anyone on the panel guess? Give me a name. I'm asking the panel.
Who train all the groups in Iraq,
Those
you
who
mean?
are hitting Saudi Arabia today and hitting Jordan today.
If the question is who's supplying them guns, 99% of the time it's
It's not
usually
about the
the
supply,
United
about who made
It's,
those
States.
who
I
made
would
those
imagine it's
groups.
Russia.
Nope, the United
Nope.
States.
Oh, the United States.
Remember when they were fighting ISIS? The United States made those groups and they trained them, and now they
Oh,
are
you mean
doing
like
all
the
of this.
Mujahideen with Afghanistan? The same thing.
Absolutely, absolutely, absolutely. So that's one issue. And now let's move on. Um, China imported some LNG from the United States. And that's when, remember when Trump went to China and China wants to be nice and they imported some LNG? Now they are re exporting it. And that is a big shock. Why they are re exporting that? Well, there are two explanations, but both of them lead to the same result anyway. The first explanation is they are importing a lot of LNG from Russia through the northern route, which is kind of a cheap LNG. But the fact is, why they are exporting the US? Because prices in Asia are very expensive. They are very high. LNG prices, in normal circumstances, they are about $11 to $12 per unit. Sometimes they go up to 15, 16. They are above 20 today. So China can make money. But it also leads to the fact that China's economic growth is very low, and probably they are already in a recession based on all the numbers that we get if you look at the import of commodities to China and you exclude the any storage buildup. So the Chinese issues here and economic growth are really a concern in this case. Now, Zelensky was hitting several targets in recent days, and it is kind of very strange the way things are going with Zelensky. Is he just, or was he told to do things, or he's just going crazy? All of a sudden, he hit a terminal in Russia that exports the Kazakhstan oil, and we lost a lot of oil at a time when oil prices were above $100, and the Trump administration said nothing. So why he is hitting a terminal that affects Kazakhstan does not affect Russia? And at the same time, he hit a an Iranian ship in the Black Sea. And why he is expanding the war of Ukraine, not only with Russia, he wants to fight with everyone, including Iran. So this is all of this happened in the same week. So there is a kind of a big question mark on this. However, loading in Kazakh in CPC or loading at CPC terminal in Russia of Kazakh oil started right now. We have an oil tanker approaching the terminal, but everyone is watching and hoping that the Zelensky will not hit that ship or the terminal again. So these are the main issues we have today. Looking forward to this week, we don't know how the kind of this deal with Iran is going to move forward, but we know one fact that the Saudi reaction to the Houthis was muted. So they did attack, but really muted, way, way lower than expected. And that kind of raises the prospect that the Saudis are pushing for some peaceful resolution to these things. They don't want to go overboard on these things. We don't know what's going on. Here, I would like to explain one more point and then I'll stop. NASA publishes a heat map around the world through via satellite, which means that they have a satellite that senses heat and they show you where there are fires, forest fires, etc. And you can measure the density of that heat too. And they were showing basically what happened at Jizan refinery in Saudi Arabia that was hit by the Houthis. The first thing is most of the videos and pictures that been posted on social media, and I'm talking about hundreds of thousands of them, are from other places, and they are old. Some of them as old as like 2016. So, and a lot of big accounts been retweeting them, etc. And the most annoying one is those who were tweeting things talking about Jizan refinery, but they were showing, if they just look, it's a building in Europe. It's a building, it's not even a refinery. Don't they see? Anyway, um, so there was only a single video, just one single video that surfaced that is a real video of the smoke, not even fire, smoke out of Jizan refinery, and that was it. And excuse me. And then people start publishing those heat maps saying, look, there is a big fire, there is a big fire. Well, if you use the same maps on Dallas and Houston, you get the same picture. But we don't have fires. So what are these? Well, any flaring basically shows up as a fire, any flaring. And the point I'm trying to convey today is this: when a refinery is shut down, on NASA's heat sensor, for those who misinterpret this, when a refinery is down, it shows it is on fire. Why? Because when it's down, it has to flare all those gases. So they have a lot of flaring. But from that picture of NASA, those who do not know, they think the refinery is on fire. So was Jazan or Jizan, they call it Jizan or Jazan, depending on the pronunciation, was Jazan refinery being hit? Yes. Were those 3 smoke columns out of it? Yes. But I did locate the location of the street where that video was taken. And if you look at the map and you look at everything, we might end up with a case where either part of it on the side being hit or some other factory next to it based on the angle there. The refinery is so huge that it cannot be damaged from those attacks. But the point here is the refinery is shut down. And when it's shut down, there will be a lot of flaring. So those who are showing things since last night and this morning, oh, look at the fires at Jizan refinery because of the heat sensing, this is not a fire. In fact, even immediately when that video was taken, it did not even show a fire, it shows smoke. So let's be careful with those heat maps. And even if you want to retweet them or anything else, please clarify that these are also could be flaring the same pictures we get from Dallas and Houston and other places. The final comment is people are complaining why the Saudis are not issuing any comments, why the Ministry of Energy did not issue any comments on this. Well, when you are at a war, and we've seen this in other countries, by the way, we've seen this even recently in Syria. When you are at a war and you have something that got hit, you don't want to show the enemy how accurate they are and whether they are accurate or not. Because even if they miss the refinery, you don't want to tell them they missed the refinery because they can adjust their aim and hit the refinery. So they are not going to issue anything. They will wait probably a week or two and then issue something general, and they are not going to tell you the details. They can tell you, well, a couple of storage facilities being hit, and that's it. And they are not going to tell you anything more about that. Back to you.
Excellent, Anas. Thank you very much for today's update. On a story that we've been following, Volkswagen's shrinking and difficulties. Porsche, partly owned by VW, and controlled by VW, is cutting another 5,000 jobs by 2035. That's on top of previously disclosed 3,900 and another 500 that they've previously disclosed. In addition, we also have numbers out from Audi, which is also controlled by VW, and they have cut their guidance on difficulties in China, excuse me, and escalating geopolitical tensions. The story just doesn't seem to be getting any better and even worse for European automakers. Dave Nikoski, go ahead.
Yeah, there was also news that came out Friday late after the close that Blackstone's co-CEO Jonathan Bach left their flagship $76 billion credit fund. This follows, what BlackRock earlier in the month of July also stepped down from their private credit fund. So you have two very, very large funds out there that you're losing the leadership of. So just something to be aware of. You know, when you look back at other periods and times, and I see some other, people that have been on Wall Street for a long time, credit default swaps on, most of the companies in the AI trade are, have moved up dramatically. Oracle being the worst. I think they're at 740 in terms of their CDS spreads on their 5 year. That's pricing in about a 12% on an annualized basis of a default, right? 12%. So just things to be aware of to market participants that are listen to our show. You're seeing it, move up again in just about everything in the AI trade. You don't have to pay attention to it now, but just be aware of it. If these continue to move up, Nvidia, backstopped what a $250 billion investment that was announced over the weekend or early this morning. I don't know what it was because I was on vacation. But they're backstopping companies that buy their chips, right? It's kind of that circular financing. But just some commentary out there.
Excellent. Eric, good morning. Go ahead.
Yeah, pretty risky for them to be doing that circular financing because there's no lack of demand for the chips anyways from other sources. So I think they're trying to protect the biggest of the American AI companies, the model companies, which I think is the wrong bet, especially if you're going to back open source, like what they're doing. I want to remind everybody that a year ago, or a year and 2 years ago, most American companies were not pro open source. Most mainstream media in the United States were not pro open source. They wanted all these models to rule and whatnot. But the reality, which I told you about back then, which China was going to push the open source because they had no choice. I want the audience to understand what happened. China had no choice because we did the chips war on them, with Trump and Biden both responsible, equally responsible. China had no choice but to go for model optimization because they didn't have enough chips. They couldn't go for scaling anymore, so they went for optimization and they decided to put it massively open source, which was what Elon Musk had done initially. So the concept is good, should be there. I totally pro it. But look at how the whole thing circled back, where they wanted to go, no, let's go full model. We have the best technology. We can sell it at price, blah 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 blah, and half right back in the face because China is forcing their hands. And all of a sudden, they're all pro. Yes, now we want to be all pro open source. Hello? Because your hands got forced, not because you really wanted it. Why not? And probably do, yeah. And Elon probably does. I mean, he was the one who tried to make it open AI. Yeah, Open AI was the name of his company because it was supposed to be open. Exactly that. But there's a bit of hypocrisy there going on. But I'm glad that they came around. I'm glad that their hands got forced. And now Dario is the one who didn't get the message. He doesn't want it. So it's going to be a very interesting fight. But Nvidia, like, look, they have like a 4 trillion market cap or whatever it is right now. If they sell some of their shares for 250 billion and it doesn't bother them too much and they backstop them, okay. If they ask banks to backstop them, it becomes more dangerous. It adds systemic risk into the system, in this AI ecosystem. I don't like that too much. So the devil's in details. I'll let the lawyers look it up over the next few days and see how it evolves. The other thing that I wanted to mention is that CXMT, so that Chinese memory manufacturer, did their IPO and they went up 400-500% overnight, beating Intel's market cap. But because that's because they have a low float, which is like 7%, because of crazy demand in RAM right now. I mean, it's the same for SK Hynix and Samsung. They got crazy valuations because of the demand for DRAM. But I would not be investing right now, except if you're like a day trader or a rapid trader, because these valuations are based on severe shortages, which means very high profit margins. Over the next few years, as every country is still racing for RAM chips, they will also race to produce them, which means over the don't keep it as a very long-term investment, because as a very long-term investment, prices should ease down as production capabilities increase over the next 3 to 5 years. I just want people to distinguish between a short-term hype and a long-term investment. Back to you, David.
Excellent. Eladio, go ahead.
You know, so like David, I've been on vacation and I'm quite not finished, but I'll be here this week at least. And so I'm looking at the technicals of the markets, and I believe we're past the halfway point of a a it's hard to even call it a correction. It's a rotational correction. Let's be honest, because we're so close. I mean, when the Nasdaq is still above, the short-term moving averages, nowhere near close, breaking down below the 50, not even getting close to the 50-day moving average. And the same thing goes for the SMH. I guess the most frustrating thing about this market is that the area that gets sold off the most when everything gets a little when we get back to the idea that maybe the data spend is not sustainable at this level, then the area that gets hit the most, the memory makers, are the ones that come back the hardest. And it's almost like the SMH has now replaced the old Fang and the old and what we call the Mag 7 as the go-to place every time the coast is clear and we have a ceasefire with Iran. Uh, I do believe, though, that we have some buying opportunities, and kudos to David Nakowski, who was really early on getting these rotations that obviously did take place. We saw a massive rotation at the end of last year and the early part of this year in financials that came out of nowhere. That's helped the market sustain its levels. And then the industrial sector to me seems like the best sector. I don't know if David wants to comment, but the relative strength that you're seeing on industrials to me is an indicator that this economy is a lot stronger than everybody thinks. And that the higher yields on the long end aren't necessarily all bad. With the dollar strength and these long term rates going up, that's what banks like. They prefer the long term rates going up. But we have a problem. The Fed is not able to raise rates. I mean, excuse me, lower rates. They're never. I don't think they're going to raise rates anytime soon, at all. The concept of that is out of the question, in my opinion. Especially as long as we have this war. But at what point are you going to start buying? So I made a decision about a week ago. I had already padded the portfolios, my business fairly well. Uh, I think there's going to be a continuation of what we see, and we're not going to see the type of rotation we would like into other areas until we get some more clarity from the Fed about the possibility of some easing at some point in the future when it's necessary. But I think the markets have pretty much given us the buy signal here to start nibbling. When are you going to buy? Are you going to buy when we're at all time highs? No, after a decline. So I think we've seen some substantial damage of the semis.
So, with regard to rates, as you all know, we will get a rate decision along with commentary on Wednesday. We'll cover that here live. And there definitely is a fair divergence of view as to. I mean, I don't think the majority is in the camp that the Fed will hold rates unchanged. There are a fair amount of folks that think that a rate hike is on the table. But that being said, I think there are more people that are expecting a hawkish commentary out of Kevin Warsh. We will see how that all goes down. And certainly in Ladio, I'm on your side with this. only because of who Kevin Warsh's boss is, only because of where I think Kevin Warsh wants to see this go, even independently, and in terms of how he has set himself up, in terms of focusing on different points of data, appointing all these task forces that are going to go ahead and inform the Fed on how to progress on a go forward basis, the less commentary and guidance that we're going to go ahead and get. So I think he's helped himself to set himself up for an eventual reduction in rates, but we'll see what Wednesday brings. And certainly, again, folks, throughout this week, we have, the largest week of earnings that are coming. We have Apple, we have Amazon, we have Microsoft, and others throughout the week. So definitely a pretty large week in terms of news cycle. George, and then over to David Koski. Morning, George.
Hi, David. Thanks for having me. So, just a couple quick points. I'll be very brief. So, one on oil. I think we're on a nice edge. The physical market colliding with the financial market. There have been repeated huge dumps, really weird prints, millions of barrels. I retweeted somebody else's post this morning about it. I did a great podcast a week ago with Mike Rothman. Laid it all out, and he's the senior energy analyst in the street. He counts all the barrels. We've had an unprecedented 1.5 billion barrel decline, forfeited oil, either reduced production inventories, or oil that wasn't produced. And there's a very good correlation between inverse correlation between inventories and prices. You look at both sides. Like my crystal ball is no better than anybody else's, so it's become a national pastime for everyone trying to figure out who's going to do what. But as he points out, I think it's the right point. The Iranians have discovered they've got leverage now that they've never had before, controlling the Straits of Hormuz, and it's an existential imperative for them to stick to their game. And ditto on the other side, from the U.S. side, it's an existential imperative for us not to allow that. Not to mention the nuclear possibilities. So I don't. I think we're headed for something. What, I don't know. I don't think either side's going to blink, and so I'd watch that. I'd watch that space. I'm very bullish on energy equities. Um, as far as tech goes, I heard the comments earlier. I agree with them about the Nvidia transaction with OpenAI. To me, it's a huge negative. Yeah, they give them the money, but that tells you really all you need to know, that OpenAI had to rely on Nvidia to get the money. Tells you how unavailable financing is becoming elsewhere. So to me, it's a huge tell. It's past 2 a.m. on the AI trade. We've been short semis, and I think tops are a process, not an event. And when you see this up down volatility, 10% up, 10% down from one day to the next, that's the sort of thing which to me is a huge red flag, reminiscent of what we saw in the early part of 2000 before the huge top. So I'd run, not walk, away from anything technology related. And then the last point, everyone's talking about, oh, this is not a bubble. Many people are saying it's not a bubble. Look at the valuations. The PEs on these stocks aren't very high compared to 2000. History doesn't repeat itself, it rhymes. There definitely is a bubble in certain parts of the market. But what's really more important, in my view, is the earnings bubble that we're seeing. These semiconductor stocks, in particular, I think are destined to crash. People are going to look askance at what I'm about to say. And I think Eric was saying it earlier. I just want to amplify that. This is a very capital intensive, asset heavy business. To me, it's just like the shipping industry. And supply is relatively inelastic in the short run, but not in the long run. And so what happens? Prices go up quite a lot. Supply can't meet demand. And once the prices go high enough, you get the supply response. I'd like to point out, you've seen increases, announced massive increases in supply. But people say, well, the demand's going to keep going. Well, that gets back to the daisy chain financing. Maybe it will, maybe it won't. What is guaranteed is the huge supply increase. And, to put PEs on these stocks to capitalize this level of earnings is just total insanity. If you look at the shipping industry, nobody ever puts PEs on shipping stocks because the earnings are here today, gone tomorrow. Instead, you look at book value, net asset value, et cetera, et cetera. And, history would strongly suggest that buying semiconductor stocks, I'm talking about the SanDisk, Microns of the world, and there's a whole bunch of other related stuff. It's just a bad idea, 10 times book, 10 times revenues. And so again, think about it. If you're in the finance department of one of these, and it's an oligopoly, I realize that. But if you're in the finance department of one of these chip producers and you had any certainty or belief that this pricing would continue, you'd increase capacity until the cows come home. And so the capacity increase and the idea of supply outrunning demand, it's not a question of if, it's a question of when. And so people say, "Oh, look at the PE." Again, no one would ever analyze a shipping company that way, but they do it with semiconductors. So I think tech is really cruising for bruising. And then the final point I wanted to make is on liquidity. Leaving aside the screen glare from headlines from what's going on with oil, what's going on with chip prices, a lot of other stuff. The real reason for being cautious is Michael Howell earlier in the year, before the Straits of Hormuz thing ever became a thing, and Michael's been more right than anybody on markets. He's like, excess liquidity is going to start to decline. That is, if all this money is created, if it's not absorbed by the real economy, it goes into capital markets. Well, the real economy is kind of doing okay, and we have inflation, and so even though liquidity is increased, the amount of excess liquidity is actually going down because the economy is sucking out all that money, and so whether the Fed hikes, doesn't hike, I don't know. I'll leave that to you guys. They're not going to ease, or if they ease, they're only going to ease for the wrong reasons, i.e., it's in response to a crisis. So the point is, excess liquidity that drives markets, and I think we've been getting less and less of that. And I think it's going to continue. And so therefore, I'll remind everyone, we don't invest in economies, we invest in stocks, we invest in financial assets, and so that's the real reason to be cautious. And so I'll stop. In sum, there's no margin for error. There are a lot of ways to lose, very few ways to win. I like energy. I like gold stocks. These things will get hit too, though, in a generalized market decline. But I think one should be very cautious. Thank you, David.
Can I ask a quick question there? I guess to George. Um, as far as liquidity goes, so we have potentially a few major IPOs coming up. I've been critical of the Anthropic IPO and the OpenAI IPOs that are charted for this year. Those are going to provide some liquidity, I think. Now, my personal opinion, I think a lot of that is going to go to private markets. So I understand what you're saying, but do we not look at those liquidity events and say that that can go into this market a little bit more? That's going to add to the liquidity, or do you see it? And this could be your argument. Do you see it more of that could take away liquidity from the market of people trying to get into the IPO? Like, what's your thoughts there on that?
Every serious person that I follow, and it's my own belief, agrees with the former, not agrees with the idea it's going to take liquidity away. Because in the first instance, the money that's going to be invested in these IPOs is money that could have gone somewhere else. As Michael Howell always says, all money has to be somewhere. It's a question of where. So money that goes into those IPOs is money that would have gone somewhere else. And so, yeah, you may say, well, okay, the people who sell those shares, they've got liquidity, and what will they do with it? Fine. You correctly identify this is a call on liquidity. And one feature of markets in recent years has been the fact that we've had massive stock buybacks. And actually, I'm really glad you asked this question because that triggers another point. We've had massive stock buybacks and very little issuance. So your question had to do with the issuance side, which is clearly going up, not just in total dollars, but also if you liken it back to .com, people say, well, market cap was so much lower last time, blah, blah, blah. Yeah, but even if you look at IPO issuance relative to market cap, it dwarfs what we saw in 99, 2000. I mean, you had hundreds of companies coming public then, but the total dollars was a fraction of what you're seeing with these mega IPOs. And the other side of the equation is supply and demand for stocks. Demand for stocks. This is one of the real reasons to be bearish on hyperscalers. These guys, Zachary Marks made the point to me. We talk about gold stocks and how they're de-equitizing now because they got all their excess cash flow to be able to buy back stock. And he asked me, he goes, well, why the hyperscalers do so well for so many long? Why did Max 7 do so well for so long? So aside from higher sales and earnings, which is the answer most of us would give, he made a very good point. He goes, these guys are buying back stock every year. And now that's stopped because they're pissing all their money out the window on the on the AI project. Not only are they buying back, not only they have to stop buying back stock, they're having to run down their balance sheets. And so, no, I think yours is a very good question. I think it's a huge negative for markets, and I'd be very cautious. Thanks for the question.
Go ahead, David Nikoski.
Yeah, I wanna say, George, great job on SpaceX and Tesla. You've been bearish. I try to time them. Um, Tesla's down versus the S&P roughly 45% since January, just to give people an idea. He covered SpaceX thoroughly. I agree with him, but I have to stick to the charts. My opinion and charts are two different things. So you nailed the SpaceX absolutely plumb right on, and kudos to you. I think earlier I discussed, and I think I mentioned Oracle as with the credit default swaps at 740.69. It's actually CoreWeave, so I misspoke. I didn't write it down. Um, I would agree. I've talked ad nauseum on this show for months about the divergence between tech and the old economy. And when you look at, all the other sectors were pointing straight down in relative strength, and that tells you how positioning is in the market. The question is whether or not you can time it and get in at the right point. You can see it happening. You can see all the money being funneled to tech, and every other sector is down. Most investment managers went into names like Walmart and Costco. Now you look at them, I think Costco went from a relative strength high to a 2.5 year relative strength low versus the S&P 500. So some of those hiding spots that many investment managers went into, a Costco, a Walmart instead of a Home Depot or Lowe's, that is really what you're seeing. Eladio asked about, the industrial sector, and if I could, I see a trend line break in Caterpillar. I'm bearish on it. I see bottoms being put in, and these rotations are absolutely unbelievable when you're looking at relative strength. And you're seeing, by the way, Caterpillar's the number one holding in the XLI. Your next components are going to be the Aero Defense, Lockheed Martin, Northrop Grumman, Raytheon, and they're making a bottom. But if you owned them for the last 2 months, you got decimated in them. Money's rotating back into those. This is a game of ping pong, is what I'm seeing in even within sectors. I'm seeing a lot of groups are not homogenous, and that is where the correlations, where you might have one stock doing well, and the rest of them are doing like crap, right? This is more of a move that I see, in terms of rotation in groups, that correlates with something's wrong, right? You can certainly see it in a lot of retail industry. By the way, the XLY heavily skewed towards Tesla. I've talked about XLY being at 17-year relative strength lows. Well, you've just taken out several years with the Tesla decline, right? And it's the makeup of these indexes that really, this passive bid that I always hear, that, oh, you can't, just go with an ETF. There is inherently, the correlations of the components within this passive bid does not exist. I hear people saying, well, it's hard to short the market. You look at XLY and look what Tesla was doing versus Home Depot or Lowe's, right? Like completely the opposite until recently, where you've taken out the strongest name and you brought, the relative strength of XLY down even several years on this decline. So, correlations, I mentioned, I think it was the previous week, if you look at the 1 month correlation, it moved up 44% in one day, and it was literally at 5 year lows. So you're starting to see correlations move up in this market, where things are starting to all move together versus, looking at the VIX and you see that it's very low. In reality, it's low because you can't bring the index down, but individual stock skew was literally near all time highs from a historical basis. So, there's much to gather in terms of anecdotal indicators out there, but it's not so. No one's ever traded this market. It mimics a lot with the dot com era when you look at relative strength of, XLV, which is the healthcare sector. Just to give an overview of what the performance in XLV versus like something like the SOX. I threw a lot of these up on my timeline a few weeks ago. XLV is currently versus something like the SOX. Sorry, I don't have all my data sitting here. Is up like 25%. In the last since the June 22nd period. Okay. And that's an area I outlined through a number of charts up on my profile. You take the XLV versus SOX, XL, take anything. Everything was started outperforming the SOX index. So I think there's, you have to pay attention to um, when these inflected, and you're going to get some monster reflex rallies. I would agree with that. The question is whether they can overcome previous resistance levels and move above it. And I think that time is running short, as George alluded to as well. So just be cautious, some degree of caution out there. The circular financing thing, you're having Meta issue 25 billion in bonds and drop 350 billion in market cap. That's a lot of equity that disappeared. Associate, like what are they going to do to keep this spending up? I don't have the answer, but if it's issuing bonds or secondaries, neither of them are good for the equity. Back to you.
Thanks, Dave. Eladio, go ahead.
One of the problems we have with this market, and obviously healthcare tends to always have or historically have an inverse correlation to tech. Whenever tech breaks down, healthcare outperforms. But the fragmentation, even within sectors that are actually leading on a relative basis has been horrific. I mean, if you look at some of the device makers in healthcare, like, historically, like one of the highest quality of that space would be ISRG. It's been a train wreck. Same with some of the older pharmaceutical companies. There are exceptions, but this is a stock picker's market. And what I find interesting is that we had a massive correction in the semiconductor space, while Nvidia basically went sideways with Apple as a receptacle for the market because of the cash flow that those two companies have. The market prices more safety when it comes to a demise of the other Mag 7, because the two highest cash flow companies in the Mag 7 are in order, Apple and Nvidia, I believe. So the question that we have is that sector rotation has worked, but it doesn't work if you're playing necessarily on the whole. Sure, the XOV's done better on a relative basis, but you have components even within the XOV that again haven't done very well, and there's this top heaviness to the performance of every one of these sectors, as David Nakowski so aptly spoke. I mean, the XLY has always been controlled by two stocks, Amazon and Tesla, which are 40% of the index. So the minute Tesla breaks down, there goes 20% of that index. So the fragmentation of this is what also makes this market harder. Frankly, I'm stumped when it comes to semis, and I'm just looking elsewhere at this point because I just don't trust the rallies or the sell-offs at this point, with this uncertainty of not knowing where the hyperscalers are going to go with their AI spend longer term. And this is why Meta's report is so important, because they're not on the higher end of those free cash flow companies in the Mag 7. They've really been impeded by all the money they've been putting into AI spend, and their free cash flow not as bad as Oracle, which is very evident in the price of the stock. So looking at free cash flow, I think, is a good measure of looking at where these stocks are going. But we are definitely in a transition point, and there's still going to be uncertainty probably going into the next quarter as to where this AI spend is going to go in the future.
Yeah, I think more what you're saying, I agree with this 100%, Eladio. When you look at Intuitive Surgical, I mean you're dealing with a current PE of 38. Okay, for next year's PE is sitting at 31. You know, Medtronic and Boston Scientific are sitting literally at PEs of 10 to 12. And so what you're seeing is, and much like that move you saw in Walmart and Costco, where they had a higher PE than Nvidia, right? I mean, like egregiously high. You know, you're seeing money come
Since
out of
when do
growth
PEs
names.
matter?
Well, they might matter now.
They
That's
matter
right.
only
We
when
don't
they
know that,
matter.
but and they're starting to matter. They are
They are
mattering.
now. They
Look at
are now. That is
Costco. Look at
correct. That is
Walmart.
correct. They matter now.
Yeah. So, you know, I would suffice it to say it appears that the growth momentum, I mean, you could take the SPLV versus the high beta index. SPLV is absolutely wiping SPHB's butt right now. Okay. I mean, it's not it's a fact. Okay. Whether that continues, I don't know, but these are something that you have to pay, you know, some degree of attention to, that this market is certainly changing, and high PE valuations are not getting the love. You know, Apple is a safety play in the whole tech sector, and that's why you know. And if that evolves to be like a Walmart or Costco, we're going to have a bigger problem. So that's
Like,
important to
yeah.
me.
If I could just add one comment to this, which I think is it's a little bit different, but it's very germane. And then when I was talking before about liquidity and the risk factors, one very important thing I forgot to mention was the bond market. I was reliably informed that interest rates were going to go down, not up. Um, and I've been bearish on bonds for years, and for the last year or so, up until a few months ago, it wasn't working. We had taken a respite, but here it is. We have a war, and rates have gone up across the curve. And even when we had one of these, you know, many MOUs or announcements of peace, yields really didn't go down very much. And this is not about inflation. I mean, it says, well, inflation, true inflation, you know. No, it's not about that. It's yeah, inflation's sticky at a high level, but and I think it's going to go higher. But that's not really the point. Key point is you look at real rates. Real rates are surging. John Roque had a chart. I'll try to fish it out. Real rates, I think, have gone. We're almost to 2.5% or thereabouts. They're at levels they haven't been to for years. Real rates, rising real rates are kryptonite for equities. And I think a lot of people get caught up in narratives. They're not paying attention to what's happening to yields. And it's not just the long end, it's the short end. Now, whether or not they cut or don't cut, I don't know. I don't have any special opinion on that. My own view, though, is if they do cut, I actually think the long end is going to sell off because people are going to say, oh, that's not the right thing to be doing at this point in time. So keep an eye on the bond market and and by the way, on bonds, I expect yields to go materially higher, 5.5%. And that ties into the entire liquidity picture. And so as if energy, the tech wreck, the private equity, private credit wasn't enough. You got tightened liquidity and you have interest rates going up. So again, there's no certainty in life. All you can do is look at risk reward and how's the market pricing these things. And again, I just see a lot of ways to lose here and not a lot of ways to win. So I recommend caution. Thank you.
No problem. Thank you, George. It's 9:30. Brandon, I'll go to your hand and then I have a parting shot. Go ahead.
Yeah, I was just going to say real quick that for those that are startup founders or want to be startup founders in the audience, today is the last day to apply for Y Combinator. YC is such a tremendous program. It's great for the ecosystem. It's great for founders. I've had some DMs about it. You don't pay to go through YC. They actually invest $500,000 into your company for the privilege to go through YC. And that's done in two different ways. It's 125 up front for like 7% equity, and then I think 375 in an uncapped MFN, most favored nation safe. And they take pro rata rights, et cetera, et cetera. But it is such a tremendous opportunity for people who want to build a business, are building a startup. I know some of our listeners have gone through YC in the past. And it's just an opportunity to put something out into the world that you believe how the world should look, and maybe you'll be the next great company we're talking about here on Finance Daily, or shitting on here on Finance Daily about the next great stock or IPO. So I just really think and encourage people that if you want to do it, please go ahead and do it. It's a huge opportunity for people.
Excellent. Thank you for that public service announcement, Brandon. I just want to close up with two Merger Monday announcements. Brown Foreman, this is in the alcohol spirits space. Brown Foreman has been the bride or would be bride a couple times now. Sazerac has come back. For another shot at Brown Foreman, which is the producer of Jack Daniels, amongst many others. We'll see if there is, and it's not a change in price. Same price, $15 billion. Stock price of Brown Foreman has been down since the initial offer, and so maybe they think they can get a second bite at the apple here. The second piece of merger news or buyout news is that Fanatics, the sports branding, retail, um, social media platform, is buying a prediction markets license along with an existing exchange and clearinghouse from BGC. Um, regardless of what you think of prediction markets, regardless of what you think of sports betting, it is big business. It's big business and it's getting bigger. Fanatics, based on everything that it's got inside of its world, inclusive of Fanatics 2026, which just wrapped up last week in New York City, they have incredible relationships with teams, with leagues, with individual sports stars across all sports, both domestic and international. And so this makes good sense for their expansion, whether they are too late to the game at this point, based on everybody else that is competing, inclusive of casino operators, all that have their own sports books at this point that are online, along with the likes of FanDuel and DraftKings, along with the likes of Kalshi and Polymarket, along with the likes of Robinhood and everybody else in the brokering of everything space. Whether Fanatics is too late to this game, we will find out. But certainly there is no lack of interest here in terms of everybody and anybody that has any connection to prediction markets getting into this business, and whether you like it or not, it's going to get pushed on us. If you think it's been pushed on us a lot until now, I bet that you haven't seen it. The amount of advertising spending that's going to go on with respect to prediction markets is only going to get ratcheted up further and further, because it's going to be all about market share. And now the wars will really begin, and we will see this. We will get inundated by advertising. So we'll keep close ties on all that. Folks, thank you for a great show this morning. Appreciate everyone joining. Appreciate all the input. Speakers were amazing. Folks in the audience, please follow them. Thank you for joining us this morning. We will see you again tomorrow morning at 8 a.m., hopefully with less bugs and glitches out of X. And we'll have another smooth, amazing show. A big week, as we've said. Be all ginned up for earnings, hot and heavy starting tomorrow. Take care and have a great day.